So the first jobs report of the Trump presidency is a winner, with the U.S. adding 235,000 jobs, beating expectations of 197,000, with unemployment ticking down to 4.7%. Joining me now in our all-star panel is Forbes media chairman Steve Forbes, Barron senior editor Jack Hough, James Freeman of the Wall Street Journal, and Michelle Girard of NatWest Markets. Wow, what a panel. Michelle, I'll start with you. What's your impression of the jobs number? Looks pretty good.
It was. I mean, it was a great report. As you said, a nice, healthy job gain, nice performance by sectors. I mean, it was really led by goods-producing sectors. Of course, construction benefited from weather, but manufacturing looked good. The hourly earnings numbers. I was really impressed. The unemployment rate ticked down because we had even more people finding jobs than a whole bunch that came in to actually look for jobs. I mean, it was through and through a very solid report. It's like the cherry on the sundae, if you will, of all the good data that we've had for February. It really confirms the economy's got a good momentum here in early 2017.
Yeah. Steve Forbes, you agree with that?
The key thing, one of the key things to look at is something that gets no attention at all, and that is the household survey of jobs. That came in at 447,000. It's very volatile month to month, but it measures small businesses and business creation better than the traditional figure, which measures existing companies that are already on the government's radar screen. That's after a year of punk job creation in that category. So if that number continues or anywhere near that number in the coming months, that is very strong for the economy. But we still have to look at the fact that the economy itself still is sluggish, and I think that gets to the tax cut, which we'll be discussing, to get business investment really rolling and continue what looks like the beginning of real momentum.
Yeah. James, one of the important things in there, you had more people going out and looking for a job, but at the same time, labor force participation going up, unemployment ticking down. Those are stats that we hadn't been seeing necessarily moving in the right direction, at least with enough momentum.
Yeah, it's a positive report. Good news across sectors, and it's not just burger flippers, although those are important in the economy too for unskilled people to get skills. But look, this is a very good report. I think the only thing, the danger is the White House and the staff there maybe not appreciating, as Steve said, how much we still need that big tax cut. Gary Cohn, president's advisor, saying he's fine with revenue neutral, which is sort of beltway talk, meaning there's not a big net tax cut.
Uh-oh. Jack, real quick, your thoughts.
Well, one of the best parts about this was the wage growth. That's great news for the economy. It could pressure some companies that rely on a lot of U.S. labor going forward, which is exactly why, to James's point, we need to see those corporate tax cuts to help offset that earnings drag.
All right, well, Treasury Secretary Steven Mnuchin is calling on Congress to raise the debt ceiling to clear the way and roll out President Trump's agenda as our nation approaches $20 trillion in debt. Steve Forbes, you look at the debt added under the last three presidents. We can't continue to double this debt load every 8 years, can we?
No, David, and that's why it's critical. Again, getting back to the theme of tax cuts, the Federal Reserve getting out of the credit markets is essential. The only way we're going to deal with this debt is a massive amount of economic growth. After 8 years, 10 years of punk growth, 4 or 5% for a few years, the assets of the nation go up, and then eventually we'll get what we had in the late 1990s. We'll get budget surpluses. It won't be for a few years, but we got to lay the groundwork now, which means tax cuts and getting the Fed to stop mucking around with interest rates.
Well, Michelle, one thing that the Fed is going to do with interest rates is raise them, and every time they raise them, our debt service increases. We did a rough calculation saying it was about every time there's a full percentage point increase in interest rates, that adds about $100 billion a year to debt service. That's going to take a big chunk out of our ability to pay for things we want.
Well, it will just continue to put the focus on the need to get the economy to grow. And ultimately, too, we do have a spending problem in terms of the entitlement burden, and that's something that's going to become increasingly an issue as we look out over the 5 to 10 year window. So eventually that's going to have to be addressed. But we do need, I couldn't agree more with you, we need to get the economy growing more, and we need to let interest rates rise. I mean, I would argue that one of the things that's also played into this economy growing so slowly is the fact that interest rates have been kept artificially low.
Right.
We need to let rates normalize. We need to let the economy do what it's supposed to, what it can do with the help of some fiscal support and all of that. I think ultimately will have a more positive effect than the higher interest rate
And James,
costs.
there's a psychology of this. When interest rates are at zero, politicians feel like, hey, nobody's paying for it. We can increase, we can borrow as much as we want, get anything we want if we're in the government, right? Because nobody pays.
Well, it's certainly what enabled a lot of the spending of the Obama era is because interest rates were historically low, we were basically paying roughly what we were paying in the 90s to service our debt, even though the debt was much bigger. But while those rates remain low, this points out the government really should be selling a lot more long-term debt. Now, I think they ought to put it into tax cuts as opposed to infrastructure or some other spending program. But just like a homeowner, they should be doing a big refi right now.
And there was talk on the campaign trail, Jack. I don't know if you recall, but Donald Trump was saying maybe we could do some renegotiation. Nobody knows debt renegotiations like Donald Trump, but you got Mnuchin there, you got Gary Cohn. Will there be some kind of attempt to fiddle with long-term sales of treasuries in order to do this?
There might be. We've argued at Barron's that they ought to look into 100-year treasuries in order to finance some of these infrastructure plans. David, on the subject of the debt ceiling, let me just say, one of the dumbest things Congress did during the Obama years is turn the ceiling into a big fight. The time to fight about money is when it's being spent, not when the bill is being paid. Let's hope the ceiling gets raised without too much of an issue.
Well,